So, okay, now what about fund size and active management? So there's been, a lot of people have said that like once funds become large enough, bigger funds tend to index and not just go with active bets. So here's a plot of active share as a function of fund size. So fund size going in millions, from 10 million to 100 million, this is a log scale, a billion, 10 billion, and $100 billion. This is actually based on the older numbers, so it's '02 numbers. But basically what you see here is the green line, or the blue line shows you the average active share, how it kind of declines a little bit as a function of fund size. And then the red line shows you the marginal active share. In other words, let's say you start with a 10 billion fund and you give it $1 extra, how much of that extra dollar is going to be indexed versus put in active bets. Okay? And what you see is that number is somewhere like in the range of like 50, 56, 50, let's say 55, 56%. So, you see a little bit of a decline here for large cap funds. You see that active management does decline with fund size, but frankly, I actually would have expected a more dramatic effect. It looks like there's virtually no relationship for large cap funds up to about $1 billion. And then only after $1 billion do you get kind of declining active share as a function of fund size. So it could just reflect the fact that in large caps, US large caps, is a pretty liquid market. You have to be really large before you start to have an impact on the fund style. Yeah. 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 So what I mean, I have looked at kind of how persistent active management is. So I have looked at how persistent active share is, and I'm actually going to show you some numbers on that as well. It turns out that active share is actually a very persistent measure. So there are some counterexamples, like the Fidelity Magellan example that I mentioned, where a fund manager changes, and that brings about a huge change in the fund's policy. But in general, if you look across all the funds, it tends to be a very persistent measure. So anyway, I'll show you, at the end, I'll show you a slide on that as well. So, okay, what about fees and active management? Well, if you look at the same kind of distribution of funds, but you look at the fees of the top most active fund managers, their fees tend to be in the 1.3, 1.45%, a little bit higher than for other categories, but actually not dramatically higher than they are for these kind of low active share funds that are still claiming to be active. So the point is, actually, fees are relatively constant across active share, despite the fact that these guys are giving a lot more active management than these guys. So basically, the kind of the per unit fee for active management is just much cheaper if you go with the most active managers. Now, what about the evolution of active management over time? So this picture shows you funds sorted into different groups based on active share. So the bottom group is 0 to 20%. So this is index funds. Then we have these two blue groups, 80 to 100%, and 60 to 80%. These represent active managers. And you see that back in the 80s, pretty much all of the funds were very actively managed. More than 50% of the funds were in the top group. Basically, the rest of the funds were in the second group here in terms of active management. So in the 80s, funds tended to be very active. But then, as you start, going from the 80s, as you start to approach the 90s, not only does indexing emerge here, but you also have these middle groups emerge. And those middle groups are the ones that I would consider closet indexers. Basically, funds that are supposed to be active but give you pretty low active share. And you see that, that's really kind of closet indexing has really become much more of an issue lately. Especially this 20 to 40%, which is kind of an extreme closet indexing category, that actually kind of grew pretty significant in the about 2000 period. Then it's declined, but it's kind of stayed about here. So actually today, kind of compared to the last time I looked at these numbers, my previous data was in 2003. Now we have a few less of those kind of extreme closet indexers, but kind of the moderate closet indexing category has basically expanded. And in fact, it's even increased in size. So, so if you kind of look at the last few years, there's kind of an maybe disconcerting upward trend in closet indexing. Or if you're doing fund selection, of course, this kind of indicates that there are lots of funds for you to exclude from your portfolio. So it's kind of making your, as someone selecting funds, it will make your job kind of more meaningful, which is obviously good. So, what was that? One thing, I don't have good explanations for that. One thing that happened in 1998 was that 1998, the SEC required that all funds report their benchmark index in the prospectus. So it could be that disclosing the benchmark index kind of made managers more benchmark aware. And I mean, of course, before that, people had benchmarks as well, but they weren't kind of required to kind of, not every fund was required. The funds weren't required to kind of disclose their benchmarks and so on. So that could be one thing, but there might be other things going on as well. So I don't have any good reasons on that. I kind of like to think that maybe some of the heat that I was kind of hoping that some of the heat that has been on closet indexers since our paper started circulating, that would have helped a little bit, but unfortunately, it looks like closet indexers are back on march again. So, so who are the investors in these funds? There's, in terms of retail versus institutional, I haven't looked at that specifically. Actually, that's a good idea. I would kind of expect. Actually, it could really go either way. Yeah. Yeah.
And that builds the basis for those index and also institutional investors start in the 90s started to embrace a sort of core satellite strategy whereby they invested a lot of money into passive managers, maybe also in closet indexes. But okay, it's just a feeling. It's something that I noticed.
Yeah. Yeah. No, yeah. By the way, enhanced indexing is, that's right. It's also kind of risen pretty significantly. Enhanced indices, most of our sample period, they were kind of, this is in terms of assets. So they've actually, in terms of assets, they've been pretty, they've not been a significant group. But it's true that in the last few years, they've definitely become more significant as well. But they tend to be categorized in the index, in this group here. When I said index, I kind of said it a little bit loosely, meaning capturing most of the enhanced indexers as well. So, okay, now, so let me then get to performance results. The fund performance that we're going to be looking at is from 1990 to present. The main reason, well, we do it for a couple of reasons. We get a bigger fund sample that way too, but also, if you look at kind of the cross-section of active management, you see that most of the, there's really been a lot of dispersion in active management starting in about 1990. If you go back to all the way back to the 80s, pretty much all of the funds were actively managed. So, we didn't really expect to see a whole lot of action there in terms of comparing funds, in terms of how active they were. But this is when you really kind of start to see the cross-sectional dispersion in active management. So that's kind of when we would expect that might be related to fund performance as well. So, yeah.
If you look at the last picture, how are the numbers of the funds? Because if you look back at 1980, there were much less funds in general than there are in 2008. Over the last years, that has exploded.
Yeah.
Have a lot of those funds disappeared, or did just new funds emerge that happen to follow the index more?
So in terms of where if the closet indexers are new guys or guys that just kind of switch to a closet indexing strategy, I haven't looked at that. So I mean, it's true that the fund sample back in 1980 was small. It was just a couple of hundred funds, whereas here we're talking about like 1,700 funds a year. But yeah, in terms of like where the closet indexers have come from, that's something that I actually haven't looked at. So anyway, so let's get to fund performance. So this is, I'm actually going to show slightly different performance grouping what I did before. So here we have sorted funds into active share quintiles going from low to high, okay, as well as tracking error quintiles going from low to high, okay. So this is not in the handout. It's actually just something that we just did it kind of recently, so unfortunately didn't make it to the slides yet. But it kind of follows. Let me just kind of explain to you how it's related to what we've done before. It's basically the same approach, just a different way to kind of show the results as it was before. So before, in the earlier slides, we just kind of showed a lot of results on this kind of 5x5 grid, tracking error by active share. And then you could say that you have different fund styles here. But now I'm actually kind of labeling them separately. So let's say closet indexers, we're going to take the low active share guys, okay? Everything except the low active share, high tracking error quintile, because these guys, I mean, they actually have relatively high tracking error, so they're the ones that who are taking kind of bets on systematic risk as well. So those you can't really call closet indexers, but otherwise I'm taking the low active share funds as closet indexers. But these guys on the right side, they're the ones that we can call factor bets, along with what I told you before. Now, if you're doing both if you both have high active share as well as high tracking error, that would put you in a concentrated fund group, which would be the dark blue. And then if you're if your tracking error is not so high, but you do have high active share, that would put you in the stock picker category or diversified stock picker category. So this is kind of like and then finally, everything else, we can call those kind of moderately active funds. So I'm going to show you that, so it's going to I think it's going to make life a little bit easier if you kind of show numbers based on these different, these different kind of labels of the types of funds in the data, okay? So these are the ones that are labels that I'm going to be using.
And how high is the active share for the top quintile?
Top quintile, it's historically it's been the 90 to 95. I think the cutoff to get into the top quintile has been slightly over 90%.
90?
Yeah. So, okay. So now, what about how have these funds performed in the past? If we take, the most recent data, or everything from 1990 to end of 2009, so including the financial crisis, here's what we find. So here I'm showing you the different types of funds, the 5 groups of funds, and their benchmark adjusted performance before fees and expenses, okay? So this is the column that you should look at. So these numbers are this is percent per year, okay? Percent per year, net of the benchmark, and the number beneath it, the number in parentheses is the T statistic. It's the indicated statistical significance of the number. So what we find here is that across all the funds, funds have had, before fees and expenses, they've outperformed their benchmarks by about 1% per year. Okay, so this is consistent with the existing literature, or with the rest of the literature, saying that managers do seem to have some ability on average, about 1% per year. Okay, but if you look across the different groups, what you're going to find is that the closet indexers, they actually were very close to the index. In the most recent data, they actually did slightly better than the index, about 50 basis points, but not dramatically better. The moderately active guys and the guys playing factor bets also beat the index just a little bit before fees and expenses, but nothing dramatic. But then if you look at the most active funds, this is where the performance really comes from. So concentrated funds beat their benchmarks by 1.5%, stock pickers by about 2.5%. So these are the guys that really seem to have had, this is where most of the skill seems to have been concentrated. If you compare the stock picker group with the closet index group, you see the difference here. The difference is about 2%, and that's statistically significant as well.
One other question. I mean,
Yeah.
The benchmarks were the benchmarks that were chosen in the prospectus.
Yeah.
And did you check whether they sort of used a proper benchmark in terms of dividends reinvested and so on and so forth, or were there a lot of price indices as well?
Yeah, actually, some funds do report price indices as comparison, which is somewhat, it's kind of hard to understand how that could pass, but yeah, a few funds do that. In any case, the index that I use is even if you report the S&P price index, I actually use a total return index for comparison, so that's not going to be an issue here.
Because, I mean, this looks almost too good to be true, right? I mean, so every group sort of outperformed.
But notice that this is before fees and expenses.
Yes.
So after fees and expenses.
But then still, I mean, before expenses, all the different groups outperformed their respective benchmarks.
That's
It's pretty amazing.
yeah. Yeah. Well, I mean, there's other results in the literature as well that show that fund managers, on average, outperform their benchmarks before fees and expenses, just by a little bit, by about 1%. So that's kind of consistent with that. I guess what is surprising is that even the different subcategories, have all outperformed. But that's kind of, I personally would have expected this to be closer to zero, but the rest of them I didn't have like strong priors going in.
Just one more question.
Yeah.
Is it possible that when you take a different time period, that the conclusions change?
That's the reason that we compute the t-statistics here, just to give you an indication of the statistical power of the result. And it's basically, the bottom line is whenever these t-statistics are greater than 2, it tends to be a pretty good indication that it's kind of something that's that's not just a random outcome of the data, but it's actually something that kind of reliably can be established based on this kind of, and it's a pretty long history. Right now we got 20 years. In the previous version of the paper, or the one that was published, we got 14 years of data, but that was actually enough to get the statistical significance as well. So anyway, so this is kind of before fees and expenses, and then what about after fees and expenses? So from an investor's point of view, okay, from an investor's point of view, the average fund did lose to the benchmark by about 40 basis points. So the average fund has actually been a bad investment. You would have been better off going with a cheap index fund. However, if you look across the different groups, the closet indexers have lost their benchmark by about 1%. So basically, they've kind of essentially benchmark index minus fees. That's roughly been their performance. The moderately active and the factor bet guys have also lost their benchmarks by even a little bit more than the average fund. And actually, what kind of surprised me a little bit was that, so a couple of things. The stock pickers here, they're the ones that the high active share funds that actually have performed well. So they're the ones that they actually beat their benchmarks by 1.2% per year after fees and expenses. So this is the net return to the investor over a 20-year time period, so annual return. So that's kind of been a pretty good return for an investor. What surprised me a little bit was that when I looked at the most recent data, I noticed that the concentrated stock pickers weren't doing so well as they had been in the past. I think there's two things going on. The real possible explanation here is that the financial crisis was pretty harsh on the concentrated stock pickers. A lot of them lost significant amounts of money in 2008, and that's really hurt their performance. So that's kind of part of the reason. Just another kind of less exciting reason is that our data provider actually switched, so it's not going to be exactly the same. It's a little bit of a different fund sample, and that's the reason that we wouldn't expect the numbers to be exactly identical to what they were before. So.
The result is not significant.
Yeah, I mean, there's no statistical significance. Remember, the concentrated funds are the ones that have high tracking error. Because you're, a really volatile fund, it's going to be hard to estimate the average performance of those funds because of that high volatility. So that's actually another reason why this is the group where you would kind of expect the estimates to be relatively inaccurate. Whereas the nice thing about the stock pickers is that because they've got lower volatility, also your estimates of their average performance have been kind of more accurate.
Why is the relevance down compared to the benchmark before expenses?
Sorry.
For the stock pickers, it was more than 3. Now it is below 2.
Yeah, so this one, yeah, so the T-stat, it's, slightly less than 2. So yeah, I mean, this kind of reflects the fact that after fees and expenses, it's pretty hard to establish that you get outperformance relative to your benchmark. I mean, this is it's statistically significant at the 10% level, not at the 5% level. So, but actually, I should, at the same time, I should point out that if you estimate the market risk premium, just to give you a picture of the ballpark, if you estimate the market risk premium, you're going to need like about 40 or 50 years of data to establish that stocks outperform cash. So it's so when you're doing these estimates, I mean, a lot of times it's pretty hard to establish any kind of average performance.